Welcome to the first podcast of 2017 from Morningstar UK, the leading provider of independent investment research. As it's the start of the year, let's take a look at what you can expect from global markets in 2017, starting with bonds. Emma Wall, Senior Editor for Morningstar, speaks to Morningstar Investment Management's Mark Preskett, who says gilt yields may fall in 2017, but bonds still have an important role to play in investors' portfolios.
Hi, Mark.
Hi.
So it's a bit of a case of déjà vu, January 2017, because if we look at what the market is expecting in terms of interest rate rises, it's 2 to 3, but we were expecting 2 to 3 rate rises this time last year, and it didn't exactly come to pass, did it?
Yeah, absolutely. So if we look at the 10-year gilt yield, which is sort of the benchmark government bond yield that most investors look at, we're trading at around 1.35% yields. At the beginning of last year, 10-year government bond yield was at 2%, and investors expected for rate rise, a couple of rate rises and bond yields to gradually rise up to their fair value levels. That didn't come to pass, as we know. The uncertainty around the Brexit vote happened, and we actually got gilt yields traded down to 60 basis points, 0.6%, which was a record low. So while that's not our base case scenario for this year, it's still something that investors should be mindful of.
Well, of course, gilt yields remain low, and we are expecting for gilt yields to rise slightly this year. This means that prices will fall and investors will lose money. However, there is still a case to be made to include gilts in a portfolio, isn't there?
Absolutely. I mean, we even if gilt yields rise, that is a mid to low single digit loss for holders of the asset class, but they are an excellent hedge against future market nervousness, volatility, and they've proven throughout 2016 to be the ultimate hedge against equity risk. Cash is still your friend in terms of its 0% correlation to equities, but government bond yields, especially the long bond, has shown negative correlation to equity market risk.
And of course, when it did drop to that record low yield of 0.6%, you did get an uplift in price.
Absolutely. So the asset class itself returned 10.5% for investors throughout 2016, and this is with a very weak Q4 when yields rose and prices fell. So there is definitely a case to be made for holding the asset class.
Looking then more broadly at the bonds asset class, at fixed income, what should investors expect from UK corporate bonds in 2017?
So the corporate bond market is trading around fair value in our view in terms of spread levels. So spread is the difference in yield between an equivalent corporate bond relative to an equivalent government bond of the same maturity. And we see around fair value, so that does give us some protection against rising yield environment. But ultimately, the path of government bonds will impact corporate bonds, and if we see a rise in yields on the government bond side, we will see some losses on the corporate bond side as well.
So I suppose what you're saying is bonds are a great diversifier, but perhaps equities look a bit more attractive.
It's probably from a fair value perspective, yes, I think that's true. But as I said, we still think that for a cautious investor or a more defensively minded investor, government bonds and sort of high-grade corporate bonds have a place in a portfolio.
Mark, thank you very much.
Thank you.
Turning now to UK equities, we have Simon Brazier, manager of the Investec UK Equity Fund. Simon says investors should prepare for a year of volatility, but there are also opportunities in domestically focused cyclical stocks.
Hi, Simon.
Morning.
So 2016 has rather made a mockery of predictions and pollsters. However, I am going to ask you for your 2017 UK equity outlook, please.
Well, actually, we've been quite consistent despite all the machinations of the markets and politics, which is that we still think we live in a low-growth world. We still think there's plenty of external risks out there, whether it's the exiting of QE, whether it's going to be European elections. And we think that in that environment, one has to stick to one's knitting and find good quality companies. But what that means this year, I think, will be more volatility. I struggle to see the market pushing a long way ahead because of valuations and, unfortunately, a lot of uncertainty.
Now, 2016 was a good year for UK equities, for the most part because of sterling. How much does that currency play in 2017 outlooks?
Well, we've seen what sterling can do to one's portfolio, particularly because the UK market has quite a lot of overseas exposure. And so I think it will be key again. The reality is our view will be that sterling over time will strengthen as we get more certainty around the UK's position in the world, particularly relative to Brexit. Clearly, also the sterling dollar rate, which is very important for some of the biggest companies that report in dollars, will also depend on what actually the Trump administration looks like. And so there is some key uncertainty again in that area. But over time, our view would be from these levels, over time, you should see certainty come into the market and sterling appreciate.
Now, there were some key dates in 2016 which proved inflection points for the market. Do we have any of those this year looking forward?
In terms of actual dates, I mean, as I said, Trump's arrival in the US is absolutely seminal for what's going to happen in global economics and politics. And we don't really know actually how that's going to work out yet. So I will be watching that very, very closely. And of course, there's a set of European elections, which I think will set the tenor for the European project for some years to come. Will electorates really in Europe be prepared to take that next step to challenge their leaderships, to say, we don't like what you've put on the table, which would be, to some, the end of the Eurozone, the EU as it is. But we will have to see.
Now, also 2016 has been a year of themes as well as a year of currency. And those themes were the fact that miners finally began to do very well, which they hadn't done in years previously. Going into 2017, do you expect that to continue, or will we see a reversion?
I mean, there was a very clear style shift halfway through this year, and it was those companies that I would think are deemed as the value end of the market. These are the companies whose valuations are trading below their long-run averages, which was mining, it was oil, and it was banks. Some people think, like ourselves, that they have challenges, those sectors, in terms of the individual companies in the sectors within there, but you saw that mean reversion come through. Can it continue from here? Yes, it can. Having said that, when mining and oil are both up over 50%, the upside is more limited. Interestingly to me, actually, the one area of the market that has now fallen down to below its 10-year valuation average is domestic consumer cyclicals. I wouldn't say that all of them are attractive, but for the first time we are seeing companies in that area where valuations are maybe pricing in some of the uncertainty ahead.
Simon, thank you very much.
Thank you.
2017 will be the year for several European elections, including in the Netherlands, France and Germany, all of which could impact the market. Canada Life Investments Chief Investment Officer David Marchant considers the impact of these European elections on asset prices and investors.
Hello, David.
Hello.
So 2016 was a year of UK and US political upsets. Will this continue in Europe in 2017?
Well, it's a brave man who says no, isn't it, given what we saw in 2016. I think the central case must be that we keep relatively stable, but we've got elections where in the Netherlands, in France, and also in Germany. So certainly there's scope for some surprising results, given what we've seen, and who would bet against it?
And what does this mean, more importantly, for asset prices for European stocks and European bonds?
Well, again, somewhat surprisingly, the results that we saw last year, Brexit, Trump, have actually been surprisingly positive for asset prices, equities in particular. So again, it's hard to say which way it could go. I think as we run up towards those elections, there is certainly scope for some volatility around equity prices and some potential flight to safety in the core German bond markets, for example. But actually, I think the central scenario must be that Europe muddles through, and also we are looking at a background where global GDP is actually being upgraded in most parts of the world. We're seeing a shift away from monetary tightening to looser fiscal policy, particularly in the US with the arrival of Trump. A year ago we were worrying about growth rates in China. Well, China seems to be on a firmer footing, and forecasts for GDP are now seemingly starting to increase. So the overall economic background, I think, is generally slightly more favourable than we've seen for a while, but some uncertainty around asset prices if elections go an unexpected way.
And what does this mean for investors? What should investors do because certain assets look more attractive than others at the moment. But if we look at, for example, how the gilt market did in the UK in the run-up to Brexit, it looked like an unattractive asset class this time last year, but actually it did give some positive return.
Well, I do sort of, the basics of investing is to spread your risks, not to put all your eggs in one basket. And whilst fundamentally I would be supportive of equities, and I think that government bond yields are ludicrously low on a long-term basis, they probably do have some place in the portfolios, because if we do get some surprising results, then they certainly could go lower again. The central case must be that we're seeing inflation rise, growth rise, yields should go a little bit higher during the year, but I think I wouldn't put all my bets on the table for equities.
I suppose then also it's important to just remember this is 1 year out of many, and investors taking a long-term view should perhaps just hold their nerve in 2017 as they had to do in 2016.
That's right, and for those who held their nerve in 2016 have done surprisingly well. We've certainly seen in the UK, for example, returns in excess of 10% coming from equities, and same is also true in the US, despite some very strange results.
David, thank you very much.
Thank you.
Political upset can cause market volatility and investment opportunities, but perfect market timing is near impossible. So how can investors be sure to profit from the dips? We now go to Emma Wall, who shares her insight on how to profit from the upcoming European elections.
2017 holds the potential for great political upset. There are general elections in Europe, in the Netherlands, France, and Germany. Fund managers are warning that these could cause significant market volatility. But as we saw in 2016, market volatility can provide excellent investment opportunities. The difficulty is market timing. If you had invested in the depths of the Brexit vote when the market crashed, you would have seen significant returns to the end of the year. But as the professionals will tell you, market timing is near impossible to get right. One way that retail investors can get around this is through a regular savings plan. You can invest from as little as £50 a month through an investment platform. And if you set up a regular savings plan within an ISA or a SIP, these investments can be tax efficient too.
Some European equity managers struggled last year as energy and financial stocks rallied. Muna Abu Habsa, Director of Manager Research Ratings for Morningstar, suggests funds that can adjust to these changing backdrops may be best positioned for 2017.
European equity managers with a quality growth focus struggled last year. The fortunes turned for sectors that were previously bottom of the performance charts, particularly energy and materials. And towards the end of the year, we saw financials turn around as well. Because of that, value-oriented funds performed well, but also funds that don't have a predetermined style. Funds that can invest freely across the valuation spectrum, where managers are applying pragmatic approaches. There are a few funds in that area which we rate positively. So Oliver Kelton, for example, who runs Ode European Focus, he follows a disciplined, stock-driven approach, which he has successfully executed in different types of markets. He looks for companies that are undergoing material change, but he's also mindful of local trends at the sector and country levels. Because of the unconstrained nature of the portfolio, however, and also the fact that it's quite concentrated, investors should expect performance that can swing wildly over the short term, and so they should be mindful of that. Henderson European Selected Opportunities is also another example of a fund that has a pragmatic approach. So John Bennett, who has run the fund since 2010, pays close attention to macroeconomic and sector trends. He believes that an understanding of these gives him valuable insight into the prospects and behavior of European companies. He also looks for contrarian trades. So in 2010, for example, he started building up the healthcare exposure in the fund. He saw that the trend PEs for healthcare stocks were at 10-year lows, and that exposure was built up gradually over the years, and that worked out very well for investors who are in the fund. More recently, he ramped up the exposure to financials. So in 2016, we saw that exposure increase to about 30% by year end. There is a lot to like about this pragmatism. However, the managers need to have the right skill set to navigate the portfolios successfully across different types of market environments. Otherwise, things can go horribly wrong.
Is President Donald Trump a threat to emerging market returns? Paul Jackson, Head of Research for Source ETF, considers the outlook for the sector and where investors can find the best opportunities.
Hi, Paul.
Hi.
So we're here today to talk about emerging markets, and I'd like to start with the big question, which is how much of a threat is President Trump to emerging markets?
Well, clearly, I think you have to look at Trump as a potential source of problems. We've seen the effect on Mexico, on the Mexican peso, and recently his actions to bring production back to the United States. But having said that, I think that the advantages of emerging markets will overcome any potential threat from Trump. For example, demographics are still much more favourable in emerging markets than in the developed world. Debt ratios are much lower, and within that debt, it is primarily domestic. There is very little foreign debt owed by most of the emerging market governments. So I think that those advantages and cheap valuations will see emerging markets outperforming developed markets once again during 2017. And don't forget, during the fourth quarter, during December, particularly on the debt side, emerging markets still outperformed, even with the election of Trump. So with that threat there, the debt markets still outperform developed markets.
So it's fair to say that you are bullish on emerging markets. Perhaps if we could drill down a little into those markets you think are going to do well in 2017, starting with debt, where are the greatest investment opportunities?
For me, I think you always need to go to the places that other people don't want to go, so where you get the best valuations. So one fantastic example that nobody really would take seriously is Venezuelan government debt. In US dollars, at the moment, you can get a yield of more than 22%. Back in 2016, at one stage, that was 36%. So it's already come a long way. But I would look for that to fall to maybe 15% during 2017. If that happens, you're looking at a full year return in US dollars of more than 50%. Other opportunities in emerging markets, I think still the Brazilian debt market with a yield in US dollars of between 5 and 6% and a local currency yield above 11% at the 10-year level. I think that is still an attractive opportunity. And in Europe, I think Turkey offers good prospects with yields that are similar to what I just quoted for Brazil.
If we're looking then at the equity side, because it is important to have a diversified portfolio, where are you seeing the greatest opportunities within those stock markets? Yeah,
once again, I think as with debt, I would take a diversified approach. But if you're looking for some specific ideas, I think China has been a forgotten market. People were burnt perhaps quite badly. It frightened a lot of people. And I think the valuations, when you look with a PE ratio below 10, it is, I think, an attractive market. Perhaps you can get it a little more cheaply in the Hong Kong market, but also looking at other markets, once again, Turkey. I think looking at Europe, Turkey has got similar sorts of valuation ratios, a PE below 10. The market has been hurt quite badly, as has the currency. So I suspect that will be a good opportunity for 2017. And if you want to get a little more exotic, looking at Africa, where over the long term, I think the greatest opportunities exist, there I think the Kenyan stock market is quite an interesting valuation point with a PE ratio below 10 and a yield which is almost as high as the PE ratio. So those would be my three picks.
Plenty of fantastic opportunities, although we should probably caveat it won't be a smooth ride for emerging markets, will you? Investors should be prepared for volatility, but good things in the end.
Of course, this is fantastic for your pensions, but I also think, if you've got that long-term view looking towards your pensions, emerging markets are a great asset class. But I do think that throughout the year 2017, you will get some good returns.
Paul, thank you very much.
It's a pleasure.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.